All right, let's dive into something that sounds a little intimidating at first, but once you understand it, can really open doors to building wealth: the stock market. If you've ever heard someone talk about stocks, you probably have a few questions. What exactly is it? How does it work? Is it something I should get involved in, or is it just for financial experts? Well, let's break it down in a way that makes sense, especially if you're new to all of this. The stock market, at its core, is a platform where people buy and sell pieces of ownership in companies. These pieces are called stocks, or sometimes shares. Essentially, when you buy a stock, you're purchasing a tiny fraction of a company. And just like any marketplace, there are buyers and sellers. So when you buy a stock, someone else is selling it, and vice versa. Now, why do companies even sell stock in the first place? Well, it's a way for companies to raise money. Instead of borrowing money from a bank or taking out loans, companies sell shares of stock to the public. This gives them funds to grow, expand, or develop new products. In return, the people who buy stock get a chance to share in the company's success or its struggles. Here's where it gets interesting. As the company grows and does well, the value of the stock can increase. This means that the stock you bought for, say, $10 could one day be worth $20. And when that happens, if you decide to sell, you can pocket the difference. Sounds great, right? Well, it's not always that simple. The stock market can be a bit like a roller coaster. Stock prices can go up, but they can also go down, sometimes unexpectedly. The price of a stock is influenced by all kinds of things: how well the company is doing, how the economy is performing, changes in technology, or even political events. And let's be honest, the stock market can sometimes feel unpredictable. That's why it's important to understand what you're getting into. So, if you're a beginner, here's how you can get started. First, you need to choose where you're going to buy stocks. This usually happens through a brokerage account, which is just an account with a company that allows you to buy and sell stocks. You can do this through an online platform, or you can go with a traditional broker. Once you've set up your account, you can deposit money into it, and then use that money to purchase stocks in companies you believe in or think will do well. Next, you'll need to do some research. There are thousands of companies listed on the stock market, so how do you choose which ones to invest in? This part can be tricky for beginners, but don't worry, it's not about picking the perfect stock every time. It's about doing some homework. You can look into a company's financial health, their past performance, and what industry they're in. There are also tools and resources available to help you understand trends and what to watch for. Once you've picked your stocks, the next step is deciding how much to invest. You don't have to spend a lot to get started. Many people start small and gradually add more as they get more comfortable. One key point is diversification. Don't put all your money into one stock. If you only invest in one company and that company faces trouble, you could lose a lot. Instead, spread your investments across different companies or industries. This helps reduce risk. As you get more involved, you'll hear a lot about two main types of stock investing: active and passive. Active investing means you're making decisions and buying, selling stocks frequently to try to take advantage of short-term price changes. Passive investing, on the other hand, is more about long-term growth. You buy and hold stocks with the expectation that, over time, their value will rise. Many beginner investors lean toward passive investing because it's simpler and less stressful. Now, let's talk about risk. It's a big word in the stock market because it's all about understanding that your investments can go up and down. If you invest in a company and it doesn't perform well, the value of your stock could drop. However, if the company does well, you could see an increase in value. The key is not to panic when the market dips and to be patient. Stocks are generally considered a long-term investment, and over time the ups and downs tend to balance out. But that doesn't mean you won't see fluctuations. They happen, and it's important to be mentally prepared for that. So how do you know when to sell a stock? That's another tricky part. Some people sell when the stock price goes up and they make a profit. Others might hold on to their stocks because they believe in the long-term potential of the company. The decision to sell depends on your personal goals, your strategy, and the performance of the stock. Some investors use a strategy called buy and hold, which means they don't sell their stocks unless they have a really good reason, like if the company is no longer performing well or if they need the money for something else. Advantages of investing in the stock market. Potential for high returns. One of the biggest advantages is that, over the long term, stocks have historically provided higher returns than other types of investments, like bonds or savings accounts. Liquidity. Stocks are easily tradable. You can buy or sell them quickly, which provides liquidity, something that other investments like real estate may not offer. Dividend income. Some companies pay out a portion of their earnings as dividends. This can be an additional way to make money from stocks, even if the stock price doesn't go up. Diversification. The stock market allows you to invest in a wide variety of sectors and industries, giving you the ability to diversify your portfolio and reduce risk. Disadvantages of investing in the stock market. Risk and volatility. The stock market can be volatile, and there's always a risk of losing money, especially in the short term. Prices fluctuate constantly due to various factors like economic changes, company performance, or even global events. Time and effort. While it's possible to make money in the stock market, it takes time, effort, and research. If you want to make smart investment decisions, it requires continuous learning and monitoring of your investments. Emotional roller coaster. It's easy to get caught up in the emotions of the market. When stock prices go down, it can be tough not to panic. But it's important to stay calm and focus on the long-term picture rather than reacting to short-term fluctuations. The stock market is also about staying informed. It's not enough to just buy stocks and forget about them. You need to keep track of what's happening with the companies you've invested in, as well as the overall market conditions. There are plenty of resources, like financial news, reports, and analysts, that can help you make better decisions. And remember, investing is a journey. No one gets rich overnight in the stock market. It takes time, effort, and a bit of patience. So, is the stock market for you? If you're willing to do the research, manage risks, and think long-term, it can be an incredible way to build wealth over time. It's not a get-rich-quick scheme, but it's one of the best tools available for anyone looking to grow their money. In this video, we've covered the basics of the stock market, and we've given you the tools to get started. Remember, investing in the stock market can be exciting, but it's important to go in with a plan, a strategy, and the right mindset. Don't be afraid to start small, and over time, you'll get more confident. Keep learning, stay curious, and start making smarter decisions with your money. That's it for today's guide on the stock market for beginners. Thanks for tuning in, and if you're ready to dive deeper into investing or need more tips, hit that subscribe button and stay tuned for more.